Hi everyone. Uh, Seems like a slightly smaller audience than normal, probably because I failed at putting the links into my eToro feed correctly. So I guess fewer people managed to find it, but it'll be on YouTube as usual. So I'm not too concerned. So Q2 2022 has been eventful. Before we get started with the presentation, I will, of course, go through all the usual disclaimers. So, obviously, none of this constitutes financial advice. I do not understand your personal circumstances, so obviously cannot advise you on your financial situation. And I'm not a financial advisor anyway, so please bear that in mind when going through the presentation. Everything here is my own research, etc., etc., etc. Your capital is at risk if you're trading on eToro or investing in stocks or equities. So please keep that in mind. The usual situation, we'll go through an introduction about me and strategy. Again, not in too much depth because I'm sure pretty much everyone knows me by now, really, since I'm not really open for new copiers. So I don't want to spend too much time on that kind of stuff. Then we'll go through performance and look at some of the benchmarks and the markets and how they've performed, and maybe some commentary on why they've performed in the way they have. And then go through the market and trading highlights from the past quarter. So really looking at what drove markets and what drove what were some of the trades that I really executed through that time, and how was I positioning the portfolio. And then after that, we'll go into looking at Q3 and onwards, just a kind of brief outlook of what's on the horizon, and then after that, at the very end, we will have time for a short Q&A. There will be a dedicated Q&A live stream next week, so try to keep your questions a bit more focused around the past quarter or the upcoming quarter if you can, or positions that are actually in my portfolio. If you have a question that's a bit more kind of random, then I may not answer it and may skip it, but you're welcome to answer it in the next live stream in a week's time. So yeah, that's about it. Oh, and of course, this will be uploaded to YouTube, as I mentioned, hopefully tomorrow, but sometimes it takes a little bit longer. So yeah, let's get started. So about me, I've been investing for longer than I really care to admit at this point. It's it's been a while. Yeah, over 11 years of experience. I'm pretty much self-taught, although in recent years I have achieved some qualifications from CISI, so that I'm actually a bit more qualified to be doing what I do, which is nice. And actually, I quite enjoyed learning some of the stuff that I did learn. So I may even do more things like that in the future, especially on the ESG side. I'm quite interested in. My CAGR since joining eToro is over 35%. That's come down quite sharply from where it was a few quarters ago due to poor performance at the start of this year. But again, markets have been incredibly volatile. But we'll talk about that a bit more later on in the presentation. I pride myself on my ethics and kind of vision of the world. I try to invest in things that are generally good for society, and I try to essentially look at future trends and the way that the world is kind of moving and the way that I think the world should move as well. So you could even say that there's some kind of not so much political bias, but maybe kind of bias of things that I think are going to be big things in the future. In how I invest, that's a big part of how I do things, and my life generally. To be honest, it just really interests me. My background is in games and events. So I used to be a professional gamer for a short period of time. I then worked at a company called Multiplay, which hosted a lot of gaming events for publishers and developers. And on their own, they hosted the UK's largest gaming festival. So I did that for quite a while, working in logistics and in esports management. And I moved on from that in 2017. I quit all of that to go full-time as a popular investor, and I've not really looked back. I finally thought I'd add a new picture to this slide because the old one was getting a bit dull. So this is a picture from the recent eToro popular investor event in London. Me with Yoni Ashia. I think we were actually queuing for lunch at the time, but yeah, it was a really cool event. Got to meet loads of awesome guys, some of whom I even see in the comments. um, so yeah, it was a really fun event, and I thought I needed a new photo. So there you go. I do sometimes leave the house. Track record and metrics. So, as I said, 11 years of trading experience overall, but over 8 years of that is now on eToro, which means that all of my stats and metrics and trading history is pretty public for anyone to go and have a look at. So all of these metrics are based on my time on eToro. So my compound annual growth rate is 35.07%. My assets under copy, actually, because of how well earnings season is going, is actually, although this says 75 million, that was over 75 million. That was when I made the presentation, but in fact, it's actually over 80 now, I think, as of today. So it may be a while until I'm copyable again, I'm afraid, if you're watching this and hoping to be copying me sometime soon. I have over 19,500 copiers, or at least I did when I wrote the presentation. I think I might have just dropped below that in the past day or so. And my lifetime return since joining eToro is almost 1,200%, 1,187.3%, according to eToro stats. So obviously, you know, tax and things like that may actually change what the kind of return that you see from copying me, if you had copied me from day one, might actually be. A bit about my strategy. So generally, you know, none of these are really hard rules. I'm not a person that believes in strict rules for trading and investing. I generally try and look for some sort of a future trend. Sometimes they are quite distant future trends that are maybe, you know, 10 years of ramping up towards something. Sometimes they're a lot shorter than that, and you know, it could be something based off a macro event in the world, like for example COVID obviously dictated a lot of changes in the portfolio, as did the ongoing war in Ukraine. I'm also really product orientated, so I really like to spend a lot of time looking at the actual products and services that these companies are selling, and that can involve like physically looking at and walking around and testing things. So, for example, I saw the Arrival van earlier this year. I've spent far too much time looking through all of the kind of installation manuals and even installation videos for a lot of the solar companies recently, like Enphase and SolarEdge, to the point where I could probably install the panels myself and the inverters myself if I wanted to. Fundamentals is obviously a really key thing. I always consider myself more of a fundamentals driven investor than a technical driven investor. That doesn't mean that I just look at what a price earnings ratio is or EV EBITDA or anything like that and, you know, call it a day. But I certainly like to spend a reasonable amount of time going through balance sheets and earnings reports and all of the different filings that companies make. Yeah, so that's a really kind of core part of how I invest. ESG, as I said, is also really important for how I like to invest. And we may even touch on it a bit later, but I think that the world is kind of changing quite dramatically in terms of the importance of ESG investing. And I know that there's some people that probably have seen a few too many conspiracy theories about the World Economic Forum and ESG being some sort of a bad thing. But although there is a lot of greenwashing that goes on, ESG overall is a good thing. And I think that it definitely can actually make a real impact on the performance of a portfolio as well, especially as time goes on, if you are kind of ahead of the curve and recognizing where things are moving. Portfolio fit essentially just means making sure that whatever I'm buying does actually kind of complement the portfolio. So it could be that I want to diversify my approach in a certain sector. It could be that I want to try and hedge a bit of risk by shorting or taking a position that will do well if something else does poorly. So that's another thing that I try to consider with every position I put in the portfolio. And then there's sentiment analysis as well. Don't really use this as much, but it can be important. I certainly think that it helps you understand consumers and a lot of the trends that are going on in the business world and in kind of consumer mentality and things like that, and even investor mentality as well, really. So that can very often be just looking at the social media presence of different companies and products and looking at kind of consumer reports and stuff like that. And then last of all, we've got technical analysis. So TA is something that again, a bit like sentimental analysis, I don't use it for everything all of the time. It's much more relevant for cryptocurrencies because they have a lot less of the previous things that I've mentioned to really look at. But it can be a useful kind of confirmation indicator, and sometimes it can actually help you identify when something's really, really undervalued. By looking at charts and stuff, but obviously charts do not tell you the whole story, I don't think. Okay, so Q2 portfolio theme. So this is essentially how we're kind of positioned going into the quarter, and you're going to notice that there's a lot of overlap here. I think. In the portfolio at the moment. So I'll start off with hedging and dividends. So really this covers, obviously a very broad kind of set of assets and positions within the portfolio. So I do have some shorts that are open to hedge against markets at the moment in the Nasdaq, the Russell 2000, and the S&P 500 currently. But I also have some short positions in individual stocks too. So I have a short on space on Virgin Galactic currently, and there's also obviously a lot of kind of dividends in the portfolio, which may not seem like it's such a hedging kind of strategy, but in reality, really, it's kind of reflecting that I want to maintain exposure to markets, but guarantee more of a kind of stable income to some degree. Obviously, it's dividends not completely guaranteed, but it's a better way of kind of keeping exposure for potential growth while at the same time having some sort of a fallback to help kind of keep the portfolio a little bit more healthy. Although, there's arguments that if you don't have dividends, then the share price would be higher and stuff anyway. But either way, that's the strategy that I opt for generally in slightly worse market conditions. It's the same sort of thing that I did actually during COVID, but that was obviously to a much higher degree. Next up, we have transport. So transportation, I think, really has been a theme in my portfolio for some time. I'm really big into EVs and the kind of electrification of transportation, and I think it's a big trend that is going to have an awful lot of money spent on it, and potentially could yield an awful lot of returns through economic savings for the companies involved. Rail is what I have in the picture because I think that it's something that is likely to grow very well in the future. And actually, I'm not sure if it was yesterday that I saw it, but I think there's a new bill going through at the moment in the US that is going to help rail in the US. It's actually more focused on passenger rail than freight rail, but that benefits the freight rail companies anyway, since in most cases they own the routes that the passenger services use. So there is support from the US government for rail at the moment, and I think that's really beneficial. And also, rail is generally quite a bit more predictable and stable in terms of the kind of commodities and things that are finding their way through the US. It's not used so much for delivering like individual items, but it's much more for like really kind of mass-produced products. So things like cars or oil or raw materials, timber, things like that. And the picture is of Canadian Pacific simply because I added them to the portfolio reasonably recently this year. So That's why I included it. Industrials and commodities. Yeah, so I've got a picture of Nell here, which kind of, I guess, fits into a lot of places. You could also consider them to be renewable. You could also consider them to be tech focused, but I mean, you could even actually consider them to be kind of transport focused in many ways because they serve that industry to some extent. Nell build electrolyzers for hydrogen, but I have a lot of exposure here as well. Again, a lot of overlap with the dividends, the same as transport. The rail companies provide decent dividends and some good stability. So do industrials. They've performed better than most sectors this year. And Nell are actually kind of much more of a growth stock in that industry. So maybe a bit more of an exception, but generally I prefer to focus on companies that really use commodities and turn them into slightly more usable products or process them rather than invest in commodities directly. Then we have utilities. So the picture here is actually of an Ørsted wind farm, I think. And utilities, the way I see it, utilities are the people that it's not necessarily the same as like renewables, for example. Utilities are really much more in the kind of servicing industry, and you know they own some infrastructure and they then provide a service with it, or you know are producing electricity. So, for example, Ørsted, although they build wind turbines for other people and wind farms for other people, they also actually sell access to their green energy. So they sell contracts essentially for their green energy directly to very, very large companies like Microsoft and Amazon, for example, and then you know guarantee that they are essentially generating all of their energy through renewables, which is pretty cool. But I also have a lot of other things in the portfolio that fall under this. So we have exposure to water, to nuclear, to you know solar and wind stuff. We have waste management in here as well. So quite a lot of stuff. And again, you know, the underlying theme here is that they're very good during kind of economic downturns because everyone needs power and everyone needs waste management and water. So they generally do reasonably well. I try to find the more ethical ones where possible, but it can be a bit difficult in this sector. But yeah, I do my best. Then we have renewables, and finally we have tech and semiconductor. Renewables, I think everyone knows that I'm a really big fan of this sector, and we've seen in recent earnings, in fact, just 2 days ago with Enphase, just how well this sector is doing at the moment. It's really one of the areas that I focus on a lot and kind of pride myself on my knowledge of. And yeah, they're destined to be a major part of my portfolio for a long time to come. In Q2, we actually kind of ramped up exposure even further because of what was going on in Ukraine as well. Tech and semiconductor, got a picture of AMD here. I actually had the wrong picture up for this during my call for this yesterday for eToro on Zoom. So I managed to find some time just before we started to actually change that to a slightly more relevant picture. Yeah, so I could have put a lot of things here. There's a lot of other things in my portfolio, but really I wanted to highlight the kind of core categories. And AMD has actually been in my portfolio for, I think, since 2016, maybe even 2015 now, when it was trading at around $3 or $4 a share. So that's why I kind of decided that I would put them in there. They've been around for a while, and I still am holding on to them now. It's kind of a good demonstration of long-term investing mindset. And obviously, I could have taken profit at numerous times along the way, but the long-term trend, I think, for AMD and for semiconductors generally is upwards as more of our life becomes digitized. Okay, so we're going to take a quick look at some benchmarks and performance metrics. I'm just going to take a drink before I do. Okay, so headline number here, minus 23.21% for Q2. So the period we're measuring, by the way, for all of, for this slide at least, is from the start of April to the end of June. So the 1st of April to the 30th or whatever of June. And I guess the key takeaway here when you look at it at a glance is that actually I did worse than everything. But that would probably, I think, be a little unfair considering that I'm only minus 0.15% behind the Nasdaq 100. The Russell would normally actually do a bit worse, but it had such a bad Q1, I think, that it didn't really it didn't really have as much to fall by during this quarter, so it actually ended up outperforming the Nasdaq 100. I'm not sure exactly why that is. There may have just been some kind of small winners in that sector. Certainly, none of mine were the big winners that were carrying markets higher. S&P 500, even that fell by almost 17%, which is obviously quite a lot. The European markets, you can see that in brackets below, I have placed another number, and that is the amount that the pound or the euro for the bottom two declined against the US dollar during the same period. So although it says, for example, that the FTSE 100 only lost 3.87%. In reality, it actually lost significantly more than that because it's measured in pounds and our portfolio is measured in US dollars. And I like to make profit in US dollars because I believe the dollar is the strongest currency. And certainly at the moment it is, as demonstrated by those statistics. So it does mean you have to be a bit more careful when you invest in Europe, which is something I do. But I put it on there just to kind of add a bit of clarity and make sure that everyone can kind of see that. So although the FTSE is minus 3.87, it's realistically somewhere around 11, and the same with the DAX and the Stocks 50, much lower than they appear. Incredibly similar, those numbers. I am kind of wondering if I could find a better benchmark for Europe more broadly, or if I should move away from the DAX to put on here, just to give us something a bit more exciting to talk about, since Germany's economy is, kind of dull in some ways, I guess. A lot of industry and car manufacturing. But yeah, overall, if you were to ask me how I felt about my performance, I would say honestly not that bad. Pretty much, in line with what I consider to be okay. I wouldn't say that it's good because it didn't outperform the Nasdaq 100, but I would say that it's pretty okay. I think it's worth remembering that the reason I use the Nasdaq 100 as my kind of core benchmark is that my goal really is to outperform that over the long term, and it may well be that I don't outperform it every single quarter, and this quarter is an example of that. But when you consider that, usually in order to outperform something, you essentially have to take more risk. What I've really kind of done here is try to reduce risk in the portfolio, especially in Q1 I did that, but in Q2 as well I even reduced risk a little bit further to try and make sure that I was more in line with the Nasdaq rather than actually taking a lot of risk to try and outperform it and ending up potentially underperforming it quite substantially. So I'm pretty okay with how things went, even though it's a big scary number. Markets like this don't happen all the time. Looking at the trailing 12 months, so the 12 months prior to this, 12 months up to this point, you can see that the only thing that is green, although again not really green, is the FTSE 100. And I think the interesting thing here is when you look at the DAX and the Stocks 50 here, you can see that when you actually take into account the currency fluctuation, they're actually performing pretty much worst of everything. The S&P 500 is what did best here, and that's not too surprising considering that it was around this time last year that the rotation out of growth and into more value names really started. So that's the point at which value stocks started to outperform more generally, and there's many more value stocks in the S&P 500 than there are in the Nasdaq or the Russell 2000, for example. I don't really think there's too much more to add to this. I mean, my performance here is terrible, but I think that's understandable considering that my last two quarters of last year were also bad. And when you consider that this year, as you'll see on the next slide, year to date, I'm down by 30.56%. By the end of June. Essentially, those 2 months at the end of the year were break even for me. So I didn't make anything, but I didn't lose anything. Whereas a lot of these did make some money into the end of the year, but I didn't. So yeah, in the past 12 months, I've definitely underperformed the Nasdaq. But I'm hoping that that will change, and I think actually even next quarter you may see this trailing 12-month number look a bit more positive for me compared to those benchmarks. Everything's relative. You can measure different time periods and see different results. Looking at year to date, as I said, minus 30.56. So essentially, I've done worse in the past 6 months than a lot worse in the last 6 months than a lot of markets have. But the interesting thing here, though, is that when you look at the Nasdaq 100, which was what was it at just now, 21.21% for the trailing 12 months, you can see that actually it ended up losing very sharply at the start of this year. So in many ways, it kind of demonstrates how much I have moved to safety, and that I kind of actually outperformed it in some ways, in that my performance didn't drop further, I guess. Yeah, I don't think there's really too much to add to these. You can see the stats. Everything is red this year. It doesn't really matter where you put your money, unless it's in oil or in Enphase Energy and SolarEdge exclusively, with nothing else in your portfolio. Then probably you would have lost money this year, or in bonds. But you're not going to really make that much with that either. So yeah, that's it really. That's the gist of it. The markets are very red. It's a painful time to be investing, but I think we are most of the way through it now. We'll talk about that later on, though. Okay, market highlight time. So really the point of this slide is to kind of talk about some of the trends that happened during the quarter, some of the big news, and things that were really driving markets, broadly speaking. We'll start out with Putin pressuring Europe on energy. Obviously, because of what's going on in Ukraine, Germany and Italy and numerous other countries in Europe that are very, very reliant on gas have been feeling quite a bit of pain as Russia has started to threaten to, and then, in many cases has, decreased the flow of gas into Europe. And I think really, Russia aren't morons. They understand that Europe is obviously very dependent on that for their economy to continue to thrive. Their economies to continue to thrive. So I think they're really looking ahead to winter. And I said this in Q1, my Q1 call as well, that they're clearly planning for next winter, and they know that this is the period at which Europe starts to stockpile gas reserves to help them through the winter, and would especially be doing that now given what's going on in Ukraine. And so they're really limiting it to try and prevent that from happening. Not too much, because obviously they will still want money. They need money to fund their war effort, and sadly, we're paying for it through gas. But yeah, I think probably we'll see that this may well end up ramping up further and further into Q3 and Q4, and really squeezing some of the countries in Europe especially hard. At the same time as this, well, not at the same time as this, really, I guess. It's actually pretty recent. In late June, Sweden and Finland essentially made the commitment that they will be joining NATO, as you can see in the photo there. So, yeah, these are two countries that tried their very best to be in a kind of neutral position regarding Russia for a very long time. But Russia was, sending planes right up to their borders and everything, and all sorts of other shenanigans to try and, I guess, put pressure and intimidate them into not joining the war in terms of the economic side of it so much. And obviously that backfired, which anyone sensible, I think, probably would have seen coming. And those countries decided to join NATO. So this obviously has, it's not something that really you can put a tangible number on how it affects markets, but it's certainly a good thing. It really shows more solidarity with the West and with Europe for those countries, and I think would help boost the economies of some of the Eastern European countries as well, who perhaps would be, in the front lines of any potential further invasion by Russia or aggression. And having these two extra countries join is obviously, adding a bit more kind of certainty to Europe's ability to defend itself overall. And obviously for those countries specifically, it adds that in, quite a large way. Next, we have, of course, the actual war itself, the Ukraine. So during the quarter, we actually saw Ukraine kind of push Russia back a bit, actually. And, I said it on here, they pushed them from the north. I mean, they actually pushed them down south quite a lot as well. And even in the east, they took back important cities like Sumy and Kharkiv, which they're still sort of fighting over now. They even tried to push into Donetsk and Kherson as well. So, but they did lose Mariupol, sadly. But as much as you can kind of sit here and look at it like it's some sort of a strategy game, this is a real war with real people in it. So it's kind of depressing, really, having to look at this stuff. But it does affect markets very dramatically, and we've seen that in food supplies and oil and gas and sand and all sorts of materials, steel, obviously, some of the gases that are used for semiconductors. Ukraine is actually a very important country in terms of a lot of different resources that kind of find their way into the supply chain for other businesses. So paying attention to it is obviously very important, and as expected, it really did drive a lot of movement in markets throughout the quarter. Next up, we have central banks increasing rates. The picture is of the Swiss National Bank, which increased rates for, I think, the first time in like 14 or 15 years. They're a bit like Japan. They've kind of got a bit of a reputation for, keeping interest rates extremely low, negative, in fact. But they did actually lift rates, as did pretty much every central bank, really, every major central bank, except the ECB, I think, during the quarter, lifted rates. So, the UK, obviously the US dramatically with Jay Powell. That caused quite a shock to the markets, especially the commentary that came afterwards. But yeah, it's really driving markets at the moment, and I think crypto especially is being driven by what's going on, which is somewhat ironic, really, especially for Bitcoin, considering what its original intention really was, which it hasn't really kind of fulfilled the promises on yet. Inflation hit new highs. Yeah, I mean, this is why the interest rates were going up. We saw the US increase dramatically to, I think, 9.1% on CPI, if I remember correctly. It's actually what that chart is of there. Obviously, most of inflation pressure is coming from energy, unsurprisingly, in most countries and certainly in Europe, and it's starting to filter its way through the economy. It leaves central banks in a difficult position because as much as they can raise rates, they can't really tackle these problems directly because of how they've manifested themselves. At the same time of this, something else that I've noticed that maybe I don't think too many people are really talking about, but I certainly think it's a really growing theme, and I have mentioned it for a few quarters even before all of the war stuff started, is really the change in working conditions and the kind of move towards unionization that we're seeing around the world, and better working conditions. So this has put massive pressure on some industries more than others. So, for example, in the UK, obviously healthcare and things like that have been chronically understaffed for a long time, and a lot of other countries as well. But in the US, the kind of battle for talent by major tech companies is ramping up, and salaries are still increasing across the board, and it's really starting to eat into the margins of a lot of those companies now, I think. So this is something pretty important to kind of pay attention to. And then on top of that, you've got the growth of unions and people starting to strike. So the picture here is of one of the rail strikes in the UK, led by unions, which is again in headlines here recently. But this is happening around the world, and it really does impact companies. I have WebTech in the US. Their staff have been striking. I have, in fact, they were striking in South America as well. I have, in fact, across the rail sector, there's been a lot of striking. You've got companies like Amazon, where the unions have started to be built for the first time. The same in Starbucks. A lot of the auto companies, the unions are trying to fight with as well. Ford, for example, moving jobs down to Mexico, and obviously the unions aren't too in favor of that. And then you've got Biden with his policies that were supposedly anti-Tesla, when in fact really what he was trying to do was support unions and support the auto companies that have unions, which Tesla does not. So it's a big trend that's going on, and it does impact a lot of companies. So I think something to be kind of watching, and something that really I think has had its catalyst moment this past quarter. So some actual trading highlights. I will get to your questions, by the way. I'm not just completely ignoring what you guys are writing. I will try and answer them when we get nearer to the end. So for Q2 trading highlights, I highlighted Elon Musk's tweet where he said that if he's successful in acquiring Twitter, he will destroy the bots and beat the bots, which is interesting since he apparently didn't know about the bots very much. I guess he did, maybe, somewhat. So I held Twitter before all of this drama happened, and I still hold Twitter now. And I actually sold, there was one position in Twitter that I sold the day before Elon Musk announced that he was making an offer for it. So sadly, I could have made like an extra 20-30% profit on that position if I had held it for just one more day, which made me very sad. But I did have other positions, so I did benefit from that, and I sold some of them after he made the offer, and some of them I continue to hold even now. And it's actually been really helpful for the Twitter share price. Twitter is actually pretty much flat for the whole year as a result of this, when pretty much every other tech company in the world is losing price at the moment, share price. So the reason I'm still holding it is that I think actually Twitter have got a pretty good case here. I don't think they're going to be able to force Elon to buy the company, because it seems a bit crazy to force someone to buy it, even though he did sign a contract agreeing to do exactly that. But certainly, the market tends to agree with me that there is upside here for Twitter, because Twitter wouldn't be flat for the year; they'd be down substantially otherwise, because that's how markets work, right? The market is trying to price in the probability of Twitter winning the lawsuit and when it's going to happen and everything else, and they've basically arrived at a number that is much higher than Twitter was trading before all of this started. So they see this overall as actually a positive for Twitter and the share price and the balance sheet of the company. And so do I. I also have a small position in Activision Blizzard, and I have a pretty sizable position in Microsoft as well, who just had their earnings recently. Microsoft put in an acquisition bid for Activision Blizzard, which is trading below the price that they would be buying at, which is pretty normal because markets, again, try to price the probability of these deals actually going through. And so I think it's very likely to go through. I don't really see any reason that it would not go through. I don't think it's causing any sort of a crazy unfair monopoly or anything. It's basically just acquiring a bunch of IP. Maybe a bit of technology stuff as well behind the scenes. And yeah, I think it's a good deal for Microsoft. So I think it's fine to hold Microsoft. And with the way that the economy was looking in January, I decided that I'd buy back into Activision Blizzard, with the CEO announcing that he was going to depart, which is one of the reasons I didn't hold it. It's got reasonable upside, better than a lot of bonds that you could pick up, for example, and a similar kind of timeline. So just holding on to that should see reasonable gains. Nothing crazy or anything, but it does help bring a bit more stability to the portfolio, which is, kind of the theme that I've been talking about a lot this quarter and last quarter. I added Canadian Pacific. to my kind of rail portfolio, and that was a good thing because Canadian Pacific and Wabtec were the two real outperformers in the rail sector. Wabtec actually produced like locomotives and some other technologies and things for trains, so they're not like a rail operator. But those two helped offset some of the slightly poorer performance that we saw from CSX and especially Union Pacific during that period. And yeah, that's good. I mean, I reduced my exposure to Union Pacific in the quarter. I increased it to Canadian Pacific, and they performed in line with what I was doing. So that makes sense. It was good that I did that. There's nothing really that crazy to talk about with it, but I just felt like it should be highlighted because, rail is really boring. It's probably one of the most boring earnings calls you can listen to. Is about trains. They just talk about how many cars of X thing they moved and what the efficiency savings of everything is. Like it's all about efficiency in railways. But I still think that especially US and Canadian rail gives you really good exposure to potential high-speed rail development in the US or the growth of more kind of consumer passenger rail services because they own most of the infrastructure, especially when you get into cities. And their freight trains have, they generally have right of way, whereas in Europe it's the other way around. But yeah, it's just an area that has done reasonably well. It's done what I wanted it to do this year, and so I kind of wanted to highlight that they're outperforming the S&P 500, and they're certainly outperforming the Nasdaq, and that's what I wanted from it. With that kind of exposure to the potential that comes with a government that's more favourable to trains and the kind of transition to more electrification and things like that, which really will help railways in the US especially. Solar was insane, absolutely insane. I think I actually did a tweet thread during Enphase's earnings last quarter, so like just over 3 months ago, essentially. It was just before my last earnings call, actually, that they reported their earnings. And I did a tweet thread about it, talked about it, and it was one of the most bizarre earnings calls I'd listened to for a while, because it was essentially full of analysts telling them that they should acquire more companies. And it was like, just everyone seemed to have an opinion, and most of them were terrible, telling them that they need to buy like heat pump companies, or that they should start doing a charging network, or all sorts of stuff that was just wild. And the reason that the analysts were so sort of, I guess, buoyed up is because the performance from Enphase that quarter was insane. They really, really did unbelievably well, and they just reported their earnings again and did the same thing again and massively surpassed expectations. They beat on every single metric again, the same as they did last time, and again lifted forward guidance as well. So yeah, solar is absolutely booming. It's something that I entirely saw coming, and in hindsight, I really wish I'd believed in my kind of analysis of the solar sector a bit more, because even personally myself, I've been looking at getting panels installed and witnessing the sheer volume of work that all of the solar companies are receiving. Pretty crazy, to be honest. Yeah, I mean, everyone is just sold out. Everyone is trying to look for more. Something else that was on the call that was kind of interesting was that Enphase started off the trend of complaining to the US government about the tariffs on China regarding a lot of solar products, and that did end up leading a few weeks later to the US changing their stance on that. So that also then acted as even more of a tailwind for the sector. And of course, you had in Europe and the UK, for example, VAT was being removed and more incentives were being lined up to help incentivize people to add panels to their houses. And last of all, we have green infrastructure. So again, same picture of Ørsted's wind farm there. And again, like, it's talking more about the kind of infrastructure plays. It's more like a combination of utilities in some sense and renewables, in terms of like that slide I showed you earlier. So companies like Ecosia and Ørsted and Trig, these are essentially asset managers. They just hold. I mean, they do some other stuff as well, but they hold these assets. They build a wind farm, but then they don't sell it. They don't build it for someone else. They just keep it, and then, potentially look after it. Or in Trig's case, they don't even do that. They're basically just a very small team that just go around buying wind farms and then outsourcing whoever looks after it and how it all works. And they just take the revenue that's generated. So it's kind of similar to when people put solar panels on their house, right? Like you make an investment in some solar panels, they're going to last, 25 to 50 years, and that they're going to generate you a return during that period. And that's essentially what a lot of these companies are doing. They're building large portfolios of solar farms, wind farms, battery storage, hydroelectric, and then just benefiting from the increasing premium that is associated with green energy, first of all, and also the increasing price, obviously, of energy. So they've done very, very well. Most of these I was positioning into in kind of late last year, when the kind of the crunch on energy was really starting. So yeah, I just wanted to highlight that as well. Orsted's actually one that's really been quite impressive when you compare it with the other wind companies like Siemens Gamsa and VWS. They've outperformed both of them quite a big way, really. So looking ahead for Q3, I mean, these are pretty much the obvious things, I think, given what I've been talking about. Interest rates are obviously going to be a major thing to look at. We saw the impact that they had just yesterday with the Fed and their next rate hike of 0.75, and the language that they were using and how much that has absolutely driven markets crazy in just the past 24 hours or so. Not even 24 hours, actually. Pretty crazy. I think what's going to be interesting is seeing how things develop in Europe and in the countries that are much more kind of less questioning if they're going to be in a recession, and instead starting to question how big that recession is going to be. So the ECB, I think, especially with what's going on with Ukraine and gas and everything else, could be in a pretty sticky situation. They're also the laggards in terms of lifting rates. The UK is also quite slow. They started early, but they've been doing very, very small incremental additions. And there are a lot of analysts and economists starting to question that now as well, and if that's really the right kind of path to be taken, if they should have gone a bit harder, a bit faster. On top of that, we've got labour markets. As I said earlier, they're becoming really quite tight, and one of the things that really caught me by surprise in the previous commentary that Jerome Powell made about the interest rates and about inflation was what he was talking about in terms of employment, and essentially trying to manage the employment situation in the US from getting too out of control. It's a bit ironic, really, because central banks, if you actually look at what the mission of central banks is, like what they're really tasked with doing, it is essentially full employment and, of course, looking after the currency. But full employment is one of like the three main things that a central bank is meant to be looking after, and yet we're hearing these slightly confusing messages where it seems like they don't really want full employment anymore because the market is too competitive and it's hurting a lot of companies, and it's just turned into a bidding war for staff in some sectors. And I think it's also adding to inflation pressure essentially as a result of that. If the cost of labor increases, then that is a form of inflation. The companies will then pass on that cost through their products, and then that will hit consumers, the same consumers that have jobs. So then they'll go back to their jobs and ask for another pay rise, et cetera, et cetera. So it's this weird chicken and egg situation. There isn't really any solution to be honest. Economics is weird like that, but it's something that's really odd and interesting, and I think, again, something that I'm keeping an eye on to just see how it unfolds, really. And then, no surprises, the last thing I put down here was the war in Ukraine. whether or not things really ramp up in Q3, I'm not too sure. It seems to be kind of a slow, steady sort of plod to try and take more territory by Russia. But at the same time, we have seen Russia sort of backtracking a little bit in terms of the rhetoric and kind of calming things down a little bit, and starting to maybe negotiate on allowing some Ukrainian businesses to export and things and have access to the ocean, whatever. But it's really, it's really not much, to be honest. And I suspect that in Q4 we'll see it ramp up again. It depends, because like you kind of got to do it. Like Ukraine's terrain is so sort of flat and boggy, um, and we saw the impact that it had in Q1 when the invasion started, with all the land being frozen and everything, and the implications of even just the temperature drop can have. So, yeah, I think winter is probably when we'll see things start to kind of kick off again potentially, especially since that's obviously when Europe has the least kind of leverage over Russia in terms of oil and gas. Uh, that's it. I made it. I made it to the end. It took me 45 minutes, but we got there. So before I start answering questions, and I will kind of scroll up and try and have a look at anything you guys have already asked and answer them if I can. Please be aware of all of the scammers on Instagram, especially, but across social media, mainly on Instagram, because Meta is an irresponsible company that doesn't give two rude words about what's going on. I mean, they don't care. It's not surprising they don't care. If you saw their earnings, to be honest, they're a pretty poor company at the moment. That I'd be tempted to short, if I'm honest, but I've resisted that urge. So Instagram, be careful of the scammers. They're trying to impersonate me. I never message anyone out of the blue and say, hey, how's your portfolio doing? Do you want to hear about my latest crypto project? Or have you considered investing through this new exchange that you've never heard of? But that's what they do, and it does work, and people sadly get scammed for lots of money. So please be very careful. Some of them even have more followers than me, which is kind of ironic. They're paid for, though. Cheaters. They're paying for their followers. So beware of that. My name on pretty much everything is Jaynemesis. If it's not spelt exactly like you see here, then it's probably not me. So please be wary of that, and watch out for friends and family and stuff as well. That's it. I will, of course, as I said, be uploading this to YouTube. But I'm going to start answering your questions. So feel free to kind of fire them in to me. And I'll go full screen on my face for this period as well, just so you can enjoy that. Oh, it's good to see Tom in the chat. I mentioned you actually in a podcast recently, Tom. I was wondering where you were, hoping you were still good. Let's see. Sri Lanka is a good example of what ESG did to the country and its economy. I'm not really sure how that's a good example of what it did to the economy. I think the example of what happened to the economy is corrupt leadership, to be honest, mainly, and also crippling debt. If you take on lots and lots and lots of debt, and then COVID happens, sad times, really. I mean, it was pretty unfortunate, to be honest, because it's one of the biggest improvements in the standard of living for that country until all of this happened, and now, of course, it's all been undone. So pretty tragic, but yeah, ESG is not to blame for that whatsoever, and I think you're delusional if you think it is. I'm afraid. Sorry if I'm offending you, but that's my opinion of it. I'm sure you'll comment on that further down. Why are we green during J stream? That is a good question. That is a very good question. Normally, whenever I stream, things are going tragically badly, so something must be up. Not sure. Is there a risk of transport of goods will slow down if there's longer-term depression, economic activity slows? There is. There certainly is. But the good news is that because inflation is very much centered around oil and gas and Canadian Pacific, which is why I added them to the portfolio, and Canadian National, and I mean, actually, even just all of the companies, I mean, Union Pacific as well, move an awful lot of oil and gas around with their trains. So I don't think demand for that is going to go anywhere anytime soon. If anything, I think countries will be wanting to build up their stockpiles, and organizations will be arranging more futures contracts. I don't think we're going to be seeing it go negative again like we did during COVID anytime soon. So I think that kind of traffic is not at too much risk. Automotive is another major kind of contributor to rail, to freight rail. And I think, if you look at Ford's recent earnings, they seem pretty optimistic about how things are going. They have their factory down in Mexico, most of the cars of which are delivered by rail. The factories that they have up around Chicago area, they're all delivered by rail as well. In terms of the kind of first step of delivery. And the same with a lot of the other EV companies. Pretty much Tesla's the only one that doesn't do it, which isn't that surprising because Elon Musk, I think, doesn't think trains should exist, it seems, even though he's sort of reinvented them with the Boring Company very, very, very inefficiently. So overall, I mean, there is some risk of some of the stuff going down, but I think that's actually more going to be impacting the kind of more traditional delivery companies. You could also make an argument that you might see freight delivery pick up, actually, because because of the kind of cost of gasoline in the US. And in Europe even as well. Ultimately, a train is the most efficient way of moving something that exists, pretty much, apart from walking, maybe, in terms of cost and capacity and everything else, and volume. So, because of that, I think you may end up seeing that fewer people want to go and drive, especially in America where you have to drive everywhere. Fewer people are going to want to drive out to these big retail parks and these massive big box stores and spend $5 on gasoline to go and buy $20 of stuff. It just doesn't really make that much sense. So actually, you might even see volumes increasing, and all of these delivery services obviously see their margins improve the more volume they actually get. So I guess something to consider. The same obviously happens in reverse though. So if the volume does drop, then we would expect to see that hitting them. But yeah, I'm not too concerned about it. It could drop, and it has dropped even, in fact, recently for most of those companies. But it's not dropping in some sort of really scary way. 10% growth in July, nice. Yeah, pretty nice so far. Pretty nice. Still a long way to go there. You've got to remember that decline of 50% in your portfolio would require 100% to earn it back. So although 10% sounds good because we were down by 30, that doesn't mean that we're back at 20%. We're still below 20%. We're at like 23 or something now. What do you expect for the second half? How will you manage different possible scenarios regarding Ukraine war, inflation, possible European recession? Yeah, the European recession is one of the hardest parts, to be honest, because I do still think it's good to have exposure to Europe and the UK. There's a lot of companies I really like in those regions, but it's hard to see anything beyond energy and utilities that make sense. And even those come with some pretty substantial risk now. We saw France has taken quite a few kind of energy-related companies international ownership again. In the UK, you're hearing talks of all sorts of potential taxes on those companies and their record profits. And it's not just the oil and gas ones, it's basically anyone who's making what's deemed to be too much money, because these countries need money from somewhere, and there's not many companies that are making money in Europe at the moment to that kind of scale. So, looking for investment opportunities in those regions can be a little bit tricky. But we'll see. I mean, the US has been doing the rounds, talking to pretty much something that I almost put in the deck, actually. The US have been kind of going around speaking to everyone. They've been speaking to Venezuela, they've been speaking to Iran, to Kuwait, you name it. If they produce oil or gas, the US has been knocking on their door, trying to make friends. And the reason they're doing that, obviously, is so that they can help support Europe and then obviously support Ukraine against Russia. Remains to be seen how that will turn out, though. Yeah, inflation, it looks like inflation is peaking in the US. I don't think it's likely to have peaked in Europe simply because of this Ukraine situation. It may have kind of peaked in the short term, but we may see things get worse again towards the end of the year. It really depends on how Russia decides to play this, and really what their kind of exit strategy from this whole situation is at this point, because I don't think really that the war is winnable in terms of taking the entire country. To be honest, I would argue that it's not really that winnable in terms of even holding on to what they've got currently. They will probably make more advances in the short term, sadly, but I think realistically that Europe is probably going to stick with Ukraine pretty firmly. It depends, though. I mean, Germany is a bit of a question mark, and Italy as well, especially with like the political situation in Italy as well at the moment. Yeah, things could get messy. Things could get messy, and I'm aware of it, and I'm kind of watching it, but it's too risky not to be invested in the markets when things are already kind of fallen this far, which I think you can see by how quickly things have just like skyrocketed in the past 24 hours. Things can change very, very quickly. So that's kind of my feeling on it. I don't know if that really answers your question, to be honest. It was kind of a broad question, though, so I hope that kind of added a bit of insight. Quick comment on Ford's earnings. Yeah, wow. I don't know if you saw my tweet. I don't usually swear in my tweets, if I can help it, but I did just basically tweet "holy shit" when I saw it. I had actually reduced my exposure by like 0.5% or so, as I think I mentioned to you on the Discord. Yeah, I'd reduced my exposure very slightly because I wasn't expecting it to be quite that good. I was expecting, some of the kind of legacy vehicles to really struggle. I was still expecting, the EV side to do well. And I think that, as I mentioned yesterday, because you also watched my call yesterday, I like where Ford's investing their money behind the scenes. It was also kind of ironic to see that the sector that let them down was the one that I told you that was one of the reasons I liked Ford, in terms of like defensiveness, which is their control over their own kind of credit for their consumers. Yeah, no, I'm obviously very happy with their earnings, to be honest, and I essentially reopened a couple of those positions this morning because, to be honest, when you see a beat of, I think it was 4 billion or something on revenue, and doubling their pretty trivial, to be fair, dividend. It just instills confidence, really, and the kind of the guidance that they essentially gave, which is that they're not really too concerned about declining volumes. When we saw GM, on the other hand, not at all on the same page as that. So yeah, it does look really promising for Ford overall, and their share price didn't really move up by that much in the grand scheme of things. So I think, yeah, it's a solid hold or potentially even a buy again now in my mind. Would love your thoughts on UK wind. I think that's UK wind, UKW. Please, Jay. It's a big component of my renewable stock, but hasn't been very steady Eddie over the last few years. Yeah, so I looked into them a pretty long time ago, actually, I think, and I haven't really looked at them since because, to be honest, I wasn't really that impressed by what I saw. I think that they're massively behind on their tech, and they essentially are relying on, like, I don't know, geography maybe, and just legacy customers and stuff. Yeah, I just don't think that they're. I don't think that they're as great as the kind of companies that you could pick up for wind in Europe. You know, the Danish companies, especially like VWS and Ørsted, I think are just so much better. And also like you know, depending on what you're looking for, I still really rate Trig very, very highly. The Renewables Infrastructure Group basically has zero overheads. They just buy these nice farms, and then they just sit there and pay out the profits as dividends. You know, it does carry a premium on the share price over the NAV, the value of their assets. But you know, it's not like ludicrous. Like crazy high premium, and you know the dividends from it are really strong. So yeah, and again, like if you're looking for renewable companies in the UK, I mean, one that I really wish was listed on eToro is ITM Power, that are doing a lot in hydrogen. I think they look really promising. There's a lot of private companies that sadly you can't really get exposure to yet in the UK that are doing lots of really good stuff in terms of wave and you know, floating technologies for wind farms and all of that kind of stuff that haven't quite gotten big enough to list publicly yet. But you know, that's an exciting area to be watching if you're kind of looking for more stuff specifically in the UK. But also, I think you know some of the Spanish companies look really good. I recently took a position in IBE.mc as it's listed on eToro, and you know they hold an awful lot of solar and stuff in Spain especially, but around the world, and a bit of nuclear even as well. For good measure, and I think that, you know, they're a pretty decent pickup. They've performed very well this year actually as well, I think. Um, yeah, that's, you know, I don't really have much else to add to it, I'm afraid. Again, I haven't looked at it really recently, but I never really found anything that exciting. Assuming that I'm thinking about the right ticker, I'm pretty sure it's UK Wind. Uh, which do you think is the better industry, wind or solar, and why do you think that? I think both are very important to have in your portfolio. They complement each other, really. At the end of the day, we just don't have the battery tech really to help us with, you know, storing enough of it when these intermittent sources are being less productive. So it's pretty important to have both. I think offshore wind actually probably has a much larger potential now. If you look at how much of the um, grid for, you know, most European countries, apart from maybe Spain and you know the UK and stuff, where their renewables come from, wind is the one that is growing by far the most rapidly. And we've just had some pretty good developments in terms of making the turbines more easily recyclable. Well, recyclable properly for the first time, whereas previously you couldn't really recycle the blades. So that's looking good. They essentially scale much more easily in some ways than solar does. Solar can be quite disruptive and is really kind of fierce market, whereas wind isn't quite as fiercely contested, although the margins in wind are a bit more questionable because of, you know, the backlogs that they've got and everything. Yeah, it's difficult to try and say which is better. I think you need both. I think you probably need nuclear as well, to be honest, in most countries at least. And yeah, as an investment, I don't see a reason to just pick one. I think both will do very well over the long term. Solar is certainly the one that seems to have the momentum at the moment, but I think that we could see that change as the wind companies kind of get more of a grasp on managing their supply chain and pricing in some of the commodity fluctuations and things that are going on. What's been your least favorite train journey ever? I have no idea. That's definitely the kind of question. I don't know how I missed that. That's definitely the kind of question that I should be answering on the stream next week, not this one. Oh yeah, probably the hot chocolate on my chinos. That was a sad one. I don't know how I missed those two questions. I think I just somehow subconsciously I must have read them and then known that they weren't very good questions really. In terms of, you know, for this broadcast at least. Which do you think is the better? I've read that one. Completely lost track of where I was because of that. Personal outlook on inflation. Will it be back to normal soon? Are you prepared for a long-term high inflation? It depends what you consider as high inflation, really. Yeah, I think the US will be able to control it much more easily than the UK, and generally any country that's got more of a grip on its energy situation will be able to control it better. But it also depends on how many other countries you're then trading with that don't have control of it to some degree. So yeah, the short answer is, if you consider normal inflation to be like 2%, then I don't think there's very many major countries that are going to be back down to 2% anytime soon. Like at least for another year or so. I think Europe really, so much of it depends on what happens with Ukraine. But I wouldn't be betting on it going below like 5% anytime soon, to be honest. Who knows though? I mean, there's just too many variables really to try and predict it accurately. But I think it does look like it's peaking in the US, and so it will probably peak this winter, I think, in Europe, because Europe kind of started behind. Asia, I think, has got a reasonable chance of controlling it somewhat, depending on what happens with China. It's just a very difficult situation to try and give you an accurate answer on. It really is a case of like everyone is watching and waiting to see what happens, including the central banks. Have you looked at Snow? Seems like a good company, and the price has come back down to earth. Honestly, I haven't looked at it since they IPO'd really, and I didn't really look at it in much depth then. Maybe I will. How much is AUM at the moment? AUC. I haven't checked it super recently, but it is around the 80 million mark, and it's AUC technically, assets under copy, because technically I'm not directly managing it. Okay, I think that's going to do for today's one, because most of these questions aren't really around this, and I want to try and keep this reasonably short. So I've done, 15, 20 minutes of questions. So I think I'll call it for now. I will be streaming again in a week if you guys want to actually ask more random questions about my favorite train journeys or whatever. I'm happy to answer those then. But for this one, I'm going to call it now. So yeah, thanks for watching. It will be available on YouTube. As I said earlier, be aware of all of the scammers and stuff that I mentioned before on social media. And if I didn't answer your question, you can always join the Discord, or you can jump onto eToro's feeds and ask me a question there as well. Or you can wait until the next stream and ask me there too. So yeah, thanks for watching everyone, and I'll see you all next time.